Welcome to vTalkInsight, Risk Sentiment Daily for December 4, 2025. Fed rate cut bets, powerful AI trends, and mounting macro risks are colliding today, leaving markets cautiously risk-on but far from relaxed. Across assets, risk sentiment today looks cautiously risk-on, yet clearly fragile beneath the surface. Equities remain supported by expectations of a December Federal Reserve rate cut and additional easing next year, while AI-related growth and solid corporate balance sheets keep the medium-term narrative constructive. At the same time, persistent worries about stretched valuations, weakening labor data, and potential overinvestment in AI infrastructure are tempering enthusiasm. Investors are adding risk selectively rather than embracing an outright risk-on regime. The anchor for this cautious optimism is the policy backdrop. A December rate cut is widely anticipated, with markets also expecting further cuts into the new year, and even the odds of a more dovish Fed chair are being priced in. That easing bias, alongside AI-driven capital spending that is credited with keeping U.S. growth around 2%, is helping support interest rate-sensitive sectors, banks, and cyclicals, and is encouraging a rotation away from the narrow mega-cap tech leadership that dominated earlier in the year. Beneath that, however, the macro undercurrents are uncomfortable. Private payrolls have surprised to the downside, job losses are concentrated in small businesses, and wage growth is slowing, all against a backdrop of housing unaffordability and multi-year cumulative inflation of roughly 24%. These pressures are feeding concerns about a K-shaped economy, with high-end consumers and select retailers holding up while middle and lower-income households face mounting strain, which in turn threatens the durability of the soft landing narrative. Structural risks round out the fragile tone. The S&P 500 is trading near 25 times earnings, the equity risk premium is barely above long-term Treasury yields, and the yield curve is steepening as long-end rates hover around the mid-4% range, in part due to heavy issuance and AI-related capital needs. Layer on fiscal deficits well above $2 trillion, unresolved geopolitical flashpoints from Ukraine to Taiwan, and regulatory unease around leverage and private credit, and it is clear why markets feel supported, but with very little margin for error. Fed easing and lower yields remain the single most important bullish driver for risk assets right now. A cut at the upcoming December meeting is widely expected, and markets have started to price in additional easing into next year. This anticipated pivot is crucial for sectors that struggled under higher rates, from banks and housing to small caps, and it is one reason we are seeing stronger performance from financials and cyclicals as investors position ahead of the decision. Recent data have reinforced that bias. A sharp miss in private payrolls, signs of rising layoffs, and cooling wage growth all point to a softer labor market, which many expect will nudge the Fed toward a more accommodative stance. Goldman Sachs, for example, anticipates that ongoing labor softness will drive further policy easing and a weaker US dollar into year-end, while systematic rebalancing in target date funds can amplify equity inflows whenever bond prices rise on dovish surprises. There are, however, clear limits to how far this rate cut story can run. Some asset managers only expect 1 or 2 cuts next year, with a terminal rate closer to 3 to 3.5%, reflecting a belief that inflation has settled in a higher regime and that prior easing has already been substantial. The bond market is also acting as a constraint, with long-dated Treasury yields elevated and the curve steepening, as investors demand more term premium in the face of large deficits and heavy issuance. For markets, that means Fed easing still supports risk appetite, but a gap between optimistic pricing and a more cautious Fed remains a key source of volatility. AI-driven growth and earnings are the second major bullish pillar for sentiment. Massive capital expenditure on AI infrastructure is a key reason U.S. growth is expected to hold near 2% this year, even as other parts of the economy slow. Technology firms are projected to invest between $3 and $4 trillion in AI over the next few years, and demand for flagship chips is so strong that orders reportedly outstrip supply by a factor of 12 to 1, underscoring just how powerful this theme has become. That investment is already showing up in earnings. Marvell has lifted its 2026 data center revenue outlook by 25% on repeat custom AI chip orders. Salesforce has beaten expectations and built over $1.4 billion in annual recurring revenue from AI products, and enterprise software backlogs at cloud leaders point to accelerating AI demand. Only a small fraction of US companies have adopted AI so far, and most corporate AI software products are less than a year old, suggesting meaningful runway as AI agents mature and are rolled out more broadly. Still, this is an early-stage cycle with real risks. Returns on generative AI capital so far are estimated at roughly 20 cents on the dollar, far below the economics of the early cloud era, and markets are increasingly questioning whether infrastructure spending is running ahead of actual demand. Technology stocks have underperformed for several weeks on worries about slower-than-hoped AI adoption, and some large investors are now approaching the AI trade more selectively, focusing on high-quality, low-leverage names. For portfolios, the AI story remains a powerful upside driver, but one where execution, differentiation, and balance sheet strength matter more with each quarter. Broadening equity leadership and earnings form the third key support for risk appetite. Market breadth has improved, with most S&P 500 constituents advancing and sectors like energy, financials, industrials, and consumer discretionary outperforming the mega-cap tech names that previously dominated returns. The KBW Bank Index is up more than 2% as investors lean into the idea that lower rates and a softer dollar can benefit financials, while expectations of a yield move toward 3.5% on the 10-year are seen as constructive for housing and other lagging areas. Earnings are also broadening beyond the largest tech platforms. Retailers like American Eagle and Five Below have raised guidance on the back of strong sales and effective marketing, while Inditex, the owner of Zara, has reported robust November growth and a more than 7% share price gain. There is evidence that smaller companies are starting to contribute more meaningfully to profit growth, something that, if sustained, could strengthen labor markets and support a more resilient overall economy. Geographically, the story is similar. Global equity markets have delivered strong returns this year, with Europe up close to the high 20s, Asia in the same ballpark, and emerging markets not far behind, helped by a softer dollar and localized growth stories. International quality stocks in markets such as India and Hong Kong are seen trading at notable discounts to broader indices, offering diversification away from the US AI complex. The broadening is not uniform and some U.S. consumer segments remain pressured, but the leadership rotation is an important counterweight to concentration risk. On the bearish side, labor and consumer weakness is emerging as a central risk to the macro outlook. November private employment fell by 32,000 jobs against expectations for a gain, marking the fourth negative reading in 6 months. Job losses are heavily concentrated in small businesses, which have recorded negative payrolls in most recent months, and wage growth has slowed for both job stayers and job changers, signaling fading labor momentum. Conditions for small firms look particularly challenging. They are squeezed by tariffs, elevated input costs, and limited pricing power, often resorting to hiring freezes and attrition instead of outright layoffs, which can mask underlying weakness for a time. Meanwhile, households are grappling with more than 24% cumulative inflation over 5 years, and affordability concerns around healthcare, housing, food, and energy now rank as the top political issue, while high mortgage rates are pushing homeownership out of reach for many younger buyers. These pressures create meaningful downside risks for growth and corporate earnings, especially in consumer-exposed sectors. Markets that are increasingly driven by passive flows linked to employment and income may prove more vulnerable if labor data deteriorate further. The picture is not uniformly negative, as high-end consumers and some discount retailers continue to report solid trends, but upcoming payroll, jobless claims, and retailer earnings will be key tests of whether the soft landing narrative can hold. The second major bearish driver is AI bubble and credit risks. Despite the strong growth story, early estimates suggest generative AI investments are currently generating only about 20 cents of return for every dollar spent, a stark contrast to the early cloud era. There is rising concern that data center and hardware capacity could be built far ahead of actual enterprise demand, raising the specter of underutilized assets and value destruction for hyperscalers, chip suppliers, and associated lenders. These worries are bleeding into the rates and credit markets. Large managers expect long-dated treasuries to underperform into 2026 as heavy AI-related capital spending and bond issuance push up term premiums, prompting underweight positions at the long end of the curve. In corporate credit, some investors are taking contrarian stances against investment-grade debt, citing tight spreads, the prospect of substantial new issuance to finance AI projects, and diminished duration tailwinds in an environment where growth and policy rates may remain relatively elevated. Broader credit structures add to the unease. Private credit has ballooned to around $2 trillion in assets, drawing regulatory scrutiny over opacity and systemic risk, while credit default swap spreads for companies ramping AI-related debt, such as Oracle, have widened. Regulators are also pushing back on leverage more generally, blocking new high-leverage exchange-traded products and flagging concerns about complex derivatives like zero-day options. For markets, that combination points to a higher risk of volatility and repricing in AI-exposed credit and equity, even if the long-term productivity story remains intact. The final bearish theme is stretched valuations and macro policy fragility. U.S. equity valuations are elevated, with the S&P 500 around 25 times earnings and the equity risk premium barely compensating investors relative to 10-year treasuries. Public markets are increasingly concentrated, with a shrinking pool of listed companies and a heavy tilt toward a handful of technology leaders, which means index-level valuations and volatility are more sensitive to shocks in a small group of names. Overlaying that are significant fiscal and policy uncertainties. The U.S. is running deficits north of $2 trillion, and while markets have so far largely shrugged this off, it is contributing to higher term premiums and a steeper yield curve as investors demand more compensation for long-dated risk. Within the Fed, divisions between hawks and doves remain pronounced, with inflation still around 3% and disagreement over how aggressively to prioritize employment versus price stability, while debate continues over whether to manage the entire yield curve or focus on the short end. Geopolitics and regulation round out the fragility. Ukraine funding negotiations are strained, Europe is split over how to use frozen Russian assets, and new U.S. legislation on Taiwan engagement risks further tension with China, all of which keep a persistent risk premium in the background. At the same time, regulators are tightening oversight of leverage and complex products, even as other parts of the system move toward deregulation and capital relief for banks. The net result is an environment where valuations leave little room for disappointment on growth, policy, or geopolitics. To sum up, markets are leaning cautiously risk-on, powered by expectations of Fed easing, an AI-driven growth engine, and a welcome broadening in equity leadership across sectors and regions. Set against that are mounting signs of labor and consumer strain, growing worries about an AI-fueled bubble in credit and long-duration assets, and equity valuations that offer limited cushion if policy or geopolitical risks break the wrong way. Watching how incoming labor data shape the Fed path, whether AI earnings continue to justify the capex, and how breadth evolves beyond mega-cap tech will be critical for understanding how this balance of risks shifts into year-end. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.